Prima di passare alla parte formale della mia relazione, vorrei semplicemente esprimere il mio stato d'animo.
Well, before I go to the formal part of my presentation, I would just like to express how I feel after having heard the words of Paolo. And how I feel is that of being very moved and very grateful. I'm very moved and I'm very grateful because, first of all, I find myself in a hall where there are more of the people I know than the people I don't. These are all people that have accompanied my first steps, and I can still continue to work with them today. But I remember those first steps of mine as a university person and in a university career, and it seemed to follow that video of a series of photos of the past that Paolo showed us. And when I was looking at this video clip, I continued to think of one person, a person who's no longer here today, but who is very much behind all the effort to create and build what Prometeia is, and that is Andreatta.
A lui sono rimasto particolarmente legato e con lui io ovviamente faccio I primi passi
and I was very much linked
perché
and close to him, and I in fact took my first steps at the university along with him, because in 1975 I was a fresh person at the university when the Prometeia had just started. I came from the MIT. I came back to Italy after being at MIT, and I didn't know Andreatta at the time, and Federico Caffé, who was the director of the institute where I was the assistant. It was thanks to them that I got my first placement in sociology in Trent, not in economics. And therefore, Bologna was the center of attraction. In Trent, I was one of the only two professors who actually lived in Trent, where I taught. The other was the rector, in fact, the brother of Prodi. So on Saturdays, things were rather lonely, not to talk about the rest of the week. So once I did my teaching and I'd seen my students and I'd spent some time with the students, well, then I used to come to Bologna. I would, in fact, live here. I went to the institutes, I went to the seminars, and I followed from some distance all the activity that was going on here. So Bologna became the cultural point of reference in Italy. And these were the years of Nino Andreatta. And yesterday, thinking of this conversation, I went to look at a book published by Molino that collects certain articles of his up to a certain point. And following Paolo's words again and remembering those years, well, it came to my mind that Nino Andreatta's rather brief term at the Treasury, that period was characterized and took place in a situation where inflation was above 20%, where there had been the failure of the largest Italian private bank, and the deficit had started going to two-digit figures vis-à-vis GDP, which would be seen in the 1990s, and the deficit was in fact printed in monetary terms, as some people hope today. Well, that was the situation that Andreatta faced, and that was a situation which largely he faced with great success. So obviously it's natural to compare yesterday with today. And at the end of the day, the situation appears less severe than it was yesterday, thanks indeed to Nino Andreatta. And therefore, the considerations that I want to talk to you today about are dedicated to him, and we all remember his rather unexpected judgments. And despite these judgments of him, I'm very sure that he would agree with what I'm about to say today. So now I'm going to the more formal part of my presentation. Your Excellencies, Mrs. Seragnoli, ladies and gentlemen, dear friends, at the end of a crisis that has lasted 8 years, the European economy seems finally to be on firmer ground. Recovery is now sustained by internal demand rather than by exports, and it's shown that it can resist the recent slowing of world trade. And the monetary policy has given a decisive impulse to this. The instruments put in place from June 2014, the private and public asset purchasing program, started in September last year and extended in January this year, are causing and bringing about the desired results. After what we have called the recalibration of our instruments carried out this month by the Governing Council, we expect inflation to achieve our objectives without undue delay. But we are continuing to observe very carefully the economic and financial conditions ongoing. And as I have said at the last meeting of the Council, and also more recently, it is without doubt that if the use of our instruments were to intensify to achieve our objective of price stability, if this is necessary, we will do this. But the shocks which struck our economy from 2008 weren't just of a cyclical nature, but also they were structural. And in this context, monetary policy can assure price stability, but by itself, it cannot in fact bring about a long-lasting, prosperous economy. And therefore, we have to act on demand and supply and act on all fronts consistently to consolidate the inversion of the cycle and create at the same time the conditions for solid, lasting recovery. Now, today, I'd like to talk about how different policies can help to achieve this result. Not acting sequentially, but simultaneously in their relative field of competence. So I'd first of all like to talk about monetary policy. Now, one of the characteristics of this crisis was the fall in potential growth rate of the euro area. In other words, the pace at which the economy can grow stably without overheating and without generating inflation. It is estimated that today this is 1%, before the 2% in the US, where the crisis has been accompanied by a fall of a potential growth rate. Now, that means that even if we have a strong cyclical recovery, growth will still be fairly low. Now, to ensure structural recovery, we have to elevate not only the cyclical growth in the short term, but also long-term potential growth. Now, in determining potential growth, the role of investments is crucial, and these grow the demand for today and supply for tomorrow. But in the euro area, recovery has concerned just consumption, and to a lesser extent, investments, which still today are about 15% lower than the pre-crisis values. Now, this is a weakness which is common to other advanced economies, by the way. But in the euro area, investments are slowed by three factors: the weak demand dynamic, the accumulation of debt already enormous in the period prior to the crisis, and the very precarious confidence of the private sector in the growth prospects for our economy. At the same time, as in a virtuous circle, the increase in investments, strengthening demand, consolidates recovery and makes the the debt burden less heavy and grows and increases confidence. And in this, the monetary policy can help and be fundamental to, in fact, have a return to the production and its potential level if the output gap is wide. And this is what the ECB has been doing since last year in a context of a low and extended inflation. We have, in fact, cut the official rates to negative values and have started credit easing packages. And we have, in fact, expanded our asset purchase program. From June 2014, bank lending rates went down considerably by 80 basis points for the whole of the euro area, and also 100 and to 140 basis points in the most heavily struck countries, and therefore the transmission of monetary policy has gone back to being penetrating and flowing through. In the active, we did this, but in fact we didn't have transmission of monetary policy. But, however, since June 2014, we have now started a new period. In June, in fact, you should think how significant the effect of these measures has been. In June 2014, to be able to have a similar effect on effective bank lending rates, we should have been able to lower the monetary policy rate by 100 basis points, which wouldn't have been possible at that time, which already at the minimum level. These measures, according to these monetary policies that we have already taken, according to the Eurosystem assessments, have contributed to increase the growth of the euro area by about 1% all told between 2015 and will do until 2017. With the lowering of rates, we have seen a recovery of lending to business. Last May, before the announcement of the credit easing measures, the loans, in fact, were lowered and were lowering at an annual rate of about 3% in the whole area. And from last July, the trend has stopped. And in the average of the euro area, loans have started to grow, even if only slightly. At the height of the crisis, 2012, small businesses indicated in a survey which the European Commission usually carries out, small industries and small businesses says that access to credit was their big problem, and after that there was the need to find customers. But since last April, access to credit in fact has seen to be less important on the part of these small and medium enterprises, so it has lost in importance. The terms and conditions of loans have started to converge rapidly towards its system that benefit large borrowers. Our measures have been effective in two ways. They have reduced the dispersion of the conditions of funding in the various countries of the euro area, core and peripheral countries in other words, and have compressed the dispersion of the differences between the categories of borrowers, large and small companies, in other words. All this has contributed not only to consolidate the recovery, but also to make it more flexible. The weakening of foreign demand on the part of emerging countries has been compensated and offset by higher internal demand in the euro area, especially coming from non-core economies, from the peripheral countries, in other words. And our monetary policy measures sustaining the incipient recovery have allowed us to attenuate the negative effects of the weakening of the emerging countries' economies in the major exporting countries of the euro area. It's also important that the positive effects of our measures have in fact reached the smaller companies, because that means that these companies have been perceived by these measures have been perceived by a large public and not just by a particular group of economic and social actors. And it should not be forgotten either that small and medium-sized enterprises represent 99% of the total number of businesses in Europe, and more importantly, these SMEs, in fact, employ two-thirds of the people employed. But why have these monetary policies been effective? One of the reasons why lending rates in the past were high was because, given the weakness of the economic conditions, the banks feared particularly the risk of businesses going to the wall, and therefore they increased their risk premiums. The highest rates, however, made the credit demand fall on the part of healthy companies, aggravating the economic conditions generally and justifying ex post the high risk premia demanded. And this generated a vicious circle. Now, our measures, especially operations aimed to have long-term funding and cutting the cost of funding for new loans, encouraged banks to start issuing credit again. The increased competition on the markets compressed tax rates and therefore improved credit, and therefore we were able to reverse this vicious circle. And also the private and public asset purchasing program in fact fed into the competition of the credit market, pushing down the yields on sovereigns and reducing their attractiveness, in fact, vis-a-vis loans, which now have become more important. Over and above the direct operations of financing, the analyses we have carried out has shown that the asset purchase projects have had an indirect effect on the conditions of offers of supply of credit and improving the macroeconomic prospects and further reducing risk premium. Now, these measures, unlike what some people say, have not damaged the banks. Anything but. Even if sometimes they might have led to a contraction of interest income, our measures have also caused gains in capital account for bank assets, and also in terms of volume and the quality of higher credit. Now, considering all these effects, the ECB staff thinks that the impact of our measures on the profitability of the banking sector has substantially been null for the euro area as a whole. Now, let's have a look at the other policies. Now, the efficacy of our monetary policy shows that the ECB has all the instruments needed to, in fact, bring about stability of price and therefore sustain demand. Within our mandate, we have no limits that limit our choice of the instruments to use or the way in which we use them. We can always, in fact, take inflation to our objective, and we are doing this, and we shall do this. Monetary policy cannot and must not, however, be the only instrument. On the one hand, the risk of a very accommodative monetary policy for a long time have to be faced with very prudential instruments which are appropriate. On the other hand, it's clear that there are also other economic policy instruments that can increase the efficacy of the monetary policy, including in closing what we call the output gap. In the past, the restricted possibility of employing fiscal policies has aggravated the burden placed on monetary policy. But today, the two policies appear, from this point of view, more consistent. In other words, monetary policy draws benefits if other policies do their bit within their sphere of competence. At the same time, the measure and the extent to which this has succeeded in sustaining the cyclical recovery has in fact facilitated the setting up of structural policies which in fact have met with more resistance in a weak macroeconomic context. This, of course, is not not controversial. The financial ministers and governors of the central banks, the countries of the G2 clearly expressed at the Ankara meeting this last September, saying the monetary policies will continue to sustain the economic policy consistently with the mandates of the central banks, but monetary policy cannot do it all alone. And therefore, we have to be able to offset two other factors which break investment. In other words, the excessive accumulation of debt and very low confidence levels. I'd just like to talk about 2 points. First of all, the structural reforms are clearly an essential part of the issue. Over and above current demand, investments largely depend on confidence that companies have on future prospects as to whether the conditions will be favorable for their micro level and also with regard to the macro outlook. Now, if the obstacles are significant for businesses, or if there is too much uncertainty with regard to growth outlook, well, then investments will be lower than they would otherwise be. And therefore, that's why structural reforms are very important. Reducing red tape and administrative burdens, this will lower the cost of new startups and, in fact, will make investments more effective. And if one incentivates greater labor participation and also increasing productivity, and these reforms will, in fact, encourage companies to decide to invest, because, of course, investment means that you are confident for the future. Structural reforms, therefore, are essential to carry out that part of the treaty which, in fact, has as its objective balanced growth, full employment and social advancement, and the promotion of science and technology. None of these objectives will be achieved if companies don't invest in R&D, they don't exploit new technologies, if they don't develop skills and in the upper sectors of the value chain. In other words, if we don't re-establish the conditions which will encourage high accumulation of capital in the private sector. But it's important to note also that the reforms which grow potential growth also generate a permanent increase in income, not just for the economy, but also for governments through higher fiscal yield, and also thanks to making the debt more sustainable, which of course further amplifies their fiscal room for maneuver. And therefore you have fiscal policy which is more able to stabilize the economy alongside monetary policies. Secondly, within the framework of structural reforms, particular attention has to be given to reducing excessive debt overhang. Certainly, important steps have been carried out in the banking sector with the creation of the SSM, and as a part and parcel of this, with the comprehensive assessment and the consequent considerable recapitalization of the sector, which the banking sector has conducted in the last 3 years in the Eurozone. And this has also enhanced the taking up again of bank lending, and therefore the mechanism of transmission of monetary policy. It's also evident that in some countries the high stock of impaired loans still hampers full recovery of granting of loans. Consistently high deteriorated loans continue to constrain the credit offering for various reasons, because it absorbs resources and also operational capacity. It immobilizes bank capital in non-productive lending and also reduces bank profitability. These effects, of course, hit the smaller companies, which are more dependent on credit from banks. And also the slowness with which impaired loans are reabsorbed also prevents the necessary process of restructuring of companies, during which healthy companies can start to reinvest, while the lamed up companies leave the market. So creating conditions for rapid work-through of deteriorated and impaired loans is all essential to restoring conditions conducive to the accumulation of wealth. Now, every country has its own list of actions to carry out to be able to bring about this process, and delays, in fact, severely hamper growth as a result. Now, in fact, a well-regulated regulatory framework on the insolvency, being able to distinguish solvent debtors from insolvent debtors is all important to facilitate the assessment of the assets that should be liquidated. You have to have a efficient justice system as well, and we have seen in our surveys that in fact the reduction of indebtedness is much higher in countries that have an efficient justice system. From this point of view, the recent reform of the regulations governing insolvency bankruptcy in Italy is to be assessed positively. It is estimated that bankruptcy procedures in fact will be halved, and also seizure procedures will diminish, and also more timely recoveries of guarantees will make the market value of impaired assets closer to the actual level at which the transactions take place. And the commitment towards a capital market union is another opportunity to accelerate progress on all fronts. How can I say, we talk about genuine union, must have the objective of harmonizing the insolvency systems and also to increase their quality. And this should at the same time extend the secondary market for impaired assets, meaning that banks will be able to place these on the market more readily. Now, if the union succeeds in developing European markets of securities backed by private and small and medium-sized enterprises, and you know that the UK banks have been at the forefront of this, banks will be able to diversify their credit risks, and therefore they'll be able to offer more credit to SMEs. Finally, to sustain confidence, it's important not to lose sight of the need to complete our monetary union, even when we face more urgent priorities. And in this context, the various steps carried out by the European Commission, in fact, are pointing us in the right direction. But it's very important, with a view to consolidating confidence, that these steps be part and parcel of a longer-term process. And it's only by identifying what the long-term horizons are that we will be able to eliminate the fragilities that we have in our union. So in sum, the combination of our monetary policy on the demand side and the structural reforms on the supply side will enormously contribute to create the conditions for a genuinely structural recovery. Together, monetary policy and structural reforms will in demand, the process of reduction of indebtedness and confidence, all factors which are all important to grow investments. But when we look at the question of putting in place concretely our reform agenda, it would seem that many Eurozone countries seem to be more hesitant than determined to go ahead with these reforms. And it's important to remember how the necessary changes are of such a reach that they can only be put in place if there is broad consensus. But also we have to remember how any delay in implementing structural reforms that will make a country richer and more able to face the challenges of today, that any delay in this implementation may have political explanations, but these explanations will never be of an economic nature. Thank you.